Car and General stock at the NSE has one of the most insane stories ever registered at the Nairobi Securities Exchange. And I'm saying so because just over the past 1 year, the stock or shares of Car and General Limited have appreciated by upwards of 720%. Yes, 720% in just 1 year. And looking at the appreciation across different times, in 5 days, the stock has appreciated by 24%. In 1 month, it has appreciated by 62%. Year to date, it has appreciated by 281%, meaning in just the year 2026, the stock of Car and General is up 281%. And of course, as mentioned, in 1 year, it has appreciated by 720%, making it one of the biggest share price winners at the NSE this year. But the story just doesn't end with share appreciation, because other metrics around the business have also been on the upward trajectory. Case in point, 2025 revenue was 25.34 billion Kenya shillings, an increase of 21% from 2024. Profit after tax of 2025 was 2.45 billion Kenya shillings, a growth of upwards of 365%. EPS for 2025 was 30 shillings and 50 cents, which of course it was also on the upward trajectory. And dividends for 2025 was 3 shillings and 42 cents per share, which was an increase of 327%. That tells you the stock and the business of Car and General has been on the upward trajectory. And the big question now is, after the 720% increase in the stock or share appreciation in 1 year, and also the 365% increase in profit, is Car and General still worth buying today, or has it reached the peak? Let's talk about that in this video. I'm going to analyze different aspects for you to be able to appreciate the Car and General business and even see if the stock is worth buying. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about investing and making money each and every day. In case those are kind of topics which you like, down there is a button called subscribe. Click the button to subscribe to my channel, and also while you still at it, drop a like on this video. And by the way, I recently released books about stock market investing, specifically a book which is going to assist you be able to do valuations of any stocks out there, and another book which is going to help you be able to constitute and manage a healthy investment portfolio. The links to those books are attached down below in the description and also in the comment section. Thanks to all of you who have bought the book so far. Case in point, a very good subscriber and ardent viewer of all the videos I upload called Jemo. As you can see a comment from Jemo here, Jemo did buy the books and he found the books very valuable in his investment journey. So go and grab the books while they're still up there and at an affordable price. Having said that, let's look at the business of Car and General. Starting with the profile, okay? Car and General as a company was established in 1936 in Nakuru, Kenya. And then a year later, it moved to Nairobi, of course, to tap into the market of the capital city in 1937. And then it became a public company and began raising capital in 1950. What does Car and General do? Car and General has quite a diverse or wide range of business interests. At the center of it is automotive and mobility, whereby it does do distribution of different motorcycles, like for example, TVS, the Peugeot three-wheelers, motorcycle assembly and distribution, and also it has a very strong exposure to border company in the country. Beyond that, it also does power and engineering services, right? Where it does distribute generators, marine engines, water pumps, loans, and other small power equipment. Thirdly, it has interest in agriculture and heavy equipment. Case in point, the Kubota tractors, Toyota forklifts, and even the Volon construction equipment. Simply put, a wide range of equipment utilized in the agriculture space. And then the fourth area of interest, which many people out there don't know, is that it is also in diversified businesses. Case in point, in poultry business through the Kibo farm. It is also in real estate. It is also in financial services partnerships. And also, it is a major shareholder in Watu Credit. I'm pretty sure you've heard about Watu Credit, which does provide financing services, most of acquisition of motorcycles and other electronics out there or equipment. So it is a major shareholder in Watu Credit, having a holding of 29% in Watu Credit. And beyond Kenya, this particular company also has presence in the region, right? It is in Uganda through a subsidiary in Kampala. It is in Tanzania, in Dar es Salaam and Arusha. It is in Rwanda, and of course, it also does distribution to the wider East Africa region. Countries like, for example, South Sudan, Somalia, Ethiopia, it also regularly distributes the different products to these countries. Car and General, for example, had 56% of its group sales accounted by countries beyond Kenya. And its strategy around regional expansion, electric two-wheelers, battery swapping, agriculture mechanization, and mobility and power solutions is actually working for the company because it's been able to turn the business around over the past 3 years. Having said that, let's look at financial performance of Car and General. Looking at revenue, revenue has grown because in 2024, revenue was 20.94 billion Kenya shillings. And then in 2025, it was 25.34 billion Kenya shillings, a growth of 21% on revenue. And of course, the revenue came from motorcycles recovery. As I've said, the units sold per month increased, right? Regional growth and also Watu Credit money. And the big question is Car and General becoming a bigger business, or the hike in profit was only witnessed last year and we're going to see the business struggle? Let's continue looking at the other matrices. When we look at profit growth, profit after tax did increase substantially. It increased by 365% because 2024 profit after tax was 526 million Kenya shillings. 2025 profit after tax was 2.45 billion Kenya shillings. A commendable jump, okay? And then when we look at the gross profit, also it was on the upwards trajectory because 2024 gross profit was 3.21 billion Kenya shillings. 2025 gross profit was 4.66 billion Kenya shillings, a jump of approximately 45%. Looking at the EBITDA for 2024 was 1.51 billion Kenya shillings and 2025 was 3.83 billion Kenya shillings. It more than doubled, okay? And then looking at the EPS also grew substantially because the EPS for 2024 was 6.46 Kenya shillings, and then the EPS for 2025 was 30.5 Kenya shillings, meaning EPS increased by almost 5 folds. Important observation under this: revenue grew by 21%, and of course, profit grew by 365%. This means that the business was able to significantly increase its profitability, right? It was able to lock higher margins. It also had stronger contribution from investments, case in point, Watu Credit. And even so, it had greater earnings per share, as you've seen. So, you having understood this, right? Let's look at the business quality for us to ascertain if this is a quality business, or even so, things might be off. With regards to revenue growth, I can give Watu Credit a clean bill of health for last year's revenue growth because a surge of 21% is commendable, and also it really surged operations in the region, therefore growing its Africa footprint. When it comes to gross margin, the business is strong because the gross profit did increase by 45%. And of course, the profit did actually grow faster than the revenues, which is amazing, okay? And then when it comes to EBITDA, I also give it a strong score because of course EBITDA more than doubled. And then when it comes to net profit margin, also the business did pretty well because as we've seen, the net profit margin did increase. And then some interesting measures also which are key for investors. Let's look at ROE, or return on equity. Simply put, is management generating attractive returns for the shareholders, given they have borrowed money from shareholders? The estimated ROE for Car and General was somewhere between 20% 35%, depending on where you do the calculation from. And based on these, it had a very strong return on shareholders' capital. And of course, these were supported by 2025 profitability. As you've seen, profits increased substantially. As such, ROE is also very strong. And then, when you look at cash flows of the company are also on a good trajectory. And I'm saying so because operating cash flows were 1.28 billion Kenya shillings, right? Capital expenditure was 384 million Kenya shillings, meaning the free cash flows were approximately 900 million Kenya shillings. Therefore, that tells you on the cash flows end, the company is also doing pretty well. But then again, its borrowings are upwards of 7 billion Kenya shillings. That tells you that yes, the company is generating cash, but also the balance sheet and debt still need to be monitored. Because remember, it has a debt upwards of 7 billion Kenya shillings. Having looked at the financials relating to cash flows, profitability, and so forth, let's now look at dividends, right? How has the company performed when it comes to dividends? In the financial year 2025, the company did amazing numbers because the interim dividend was 30 cents and then the final dividend was 3 shillings and 12 cents, bringing the total dividend to 3 shillings and 42 cents per share. The previous financial year, we were talking about dividends being at 80 cents. Therefore, the growth in dividends of Car and General last year was 327% growth in dividend in 1 year. Based on this, when you look at the yield, last year was approximately 1.9%, right? Which is modest, but then again, it is commendable, appreciating the business did turn around because 3 years ago, the business made a loss. And in just 2 years, it's seen a dividend ramp up by upwards of 320%. That tells you it has done amazing numbers. And the important lesson when it comes to dividend is that yes, the dividend did increase dramatically, okay, but the share price increased much faster. Therefore, if someone had invested in the stock of Car and General sometime start of last year, it means that they have benefited from both share price appreciation and also dividends growth. Now, let's look at valuation before we make a verdict about this particular stock. When you look at valuation on some of the key ratios, starting with PE ratio or price earnings ratio, the PE ratio is somewhere between 3.2 to about 5.8 times, depending on the share price and earnings you are basing to calculate. And this looks quite low compared to many companies listed at the NSE, because remember, a very ideal PE ratio is typically upwards of 10 times. So it being somewhere between 3.2 to 5.8, it tells you is pretty low. And then the next measure, which is an exciting one, is now the price to book ratio, which, guys, is very interesting because the price to book ratio of Car and General is 1.79 times, which of course is more than 1 because the ideal PB ratio should be 1 or below 1. But then again, there is no cause for alarm. And I'm saying so because investors are basically paying 1.79 Kenya shillings for each 1 shilling on book value. But on the positive end, as you've seen, the company has reasonable and strong ROE. Therefore, that somewhat kind of like balances this particular ratio. And then when you look at the dividend yield, as I've said, last year, dividend was 3 shillings and 42 cents, okay? And pegging that on the price of approximately 178 Kenya shillings per share, that tells you the dividend yield is about 1.9, right, percent, which tells us that it's not particularly that attractive per se. But then again, the dividend has grown. We can't really negate that fact because it came from a negative position to see its dividend grow. But then again, right now, it means that the current dividend yield is relatively low. And then let's look at another ratio, which is also very important for companies which are very capital intensive or they have very high investment in assets out there, which is the enterprise value against the EBITDA. And the EV/EBITDA ratio was 5.6 times to about 9.9 times. This tells us that the valuation doesn't appear excessive, right? But exact multiple depends on methodology and current market price, which you peg on. But then again, it is still under 10 times regardless. That points towards the company having some form of undervaluation. Now, when you look at the valuation, the big question is this. So far, the stock of Car and General has rallied up by over 720 times, or 720% over the past 1 year, right? And also, earnings have grown potentially. But the most important thing you need to note is that substantial portion of the earnings have come from Watu Credit, because 69% of Car and General profits came from Watu Credit. Now the question isn't as to whether Car and General is a cheap stock as of 2025, and of course reflecting this year based on last year's financial, but the key question is whether those earnings can be able to be sustained. Okay? That's the big question we need to ask ourselves, because the majority of the earnings came from Watu Credit. So will those earnings be sustained? For us to really understand that, let's look at the growth catalysts and also the risks the business is exposed to for us to conclude if the earnings can be sustained, or even so, do you need to buy in the first place? Growth catalysts, at number one, we have regional expansion. As I've mentioned, it's expanded in the larger East Africa region. And of course, the countries outside Kenya accounted for upwards of 56% of the company's sales. Secondly, the motorcycle market has really ramped up because we've seen the doubling or almost doubling of the per month unit of motorcycles sold by Car and General. Okay? And then the third catalyst is agriculture equipment, because we are talking about agriculture productivity increasing and lots of companies and also big farmers embracing the equipment, more so from Car and General. And then fourth, we are talking about power and infrastructure, where it's diversified to engines, generators, therefore also contributing towards industrial expansion. And then the fifth catalyst is new mobility technologies. Think about electric motorcycles, battery swapping, and even CNG vehicles and so forth. This tells us there's potential for the business to continue growing. And of course, the sixth catalyst, which also last year contributed a huge chunk to the company's profit, is Watu Credit. And Watu Credit matters because of the significant earnings contribution and a strong contribution around profitability over the recent years. But this is also one of the biggest risks, because it means if Watu Credit business goes down, it means also the stock and the business of Car and General is bound to be affected. Therefore, talking about that, let's look at the risks. Number one risk is motorcycle market risk. From the angle of consumer financing conditions matter when it comes to the consumers accessing motorcycle. So in case of challenges on that end, the company might see the motorcycle market reduce. Secondly, consumer purchasing power. Let's face it, we are in a situation where we can confidently call economic shutdown, because the cost of living has really increased. Therefore, people out here don't really have much disposable income to purchase maybe things like motorcycles and so forth. So consumer purchasing power could also be a risk. Third risk is currency risk. And I'm saying so because operations across multiple East Africa countries and currency movements can affect reported results because of currency risk. The third risk is regional economic risk. And I'm saying so because Uganda and Tanzania are increasingly becoming important, right? Therefore, the more it's exposed to the region, and of course, that's good diversification, but also the more the external risk. And then fifth is Watu Credit. Guys, this is a key thing because the question here is earning sustainability, right? And this is so because Watu Credit contributed 69% of this company's earnings in 2025, right? So if Watu Credit's profitability normalizes, it means the group's earnings are going to decline, the EPS could fall, and also key ratios like, for example, the PE ratio are bound to become less attractive. So the big question is, will the run around Watu Credit continue as a going concern, or is bound to also decrease? And then the sixth risk is share price risk. And I'm saying so because we've seen the share price increase exponentially over the past 1 year and even so in 5 years' time, because even in 5 years, it's increased by over 1,000%. The key question now is, a stock can be fundamentally attractive, okay, and still be a bad investment if you buy at the wrong price. So in case you buy right now, are you going to be buying at the right price, or the recent rally has made the shares of this particular company to already peak? Now let's jump on my verdict. Would I buy this particular stock or no? Okay, my verdict is that I do something called hold and watch. And I'm saying so because I would hold, okay, and continue monitoring earnings, okay? Continue watching how Auto Credit is performing. Watch the cash flows, monitor debt, and also monitor regional growth, okay? That is in case I'm owning this particular stock. So that will really assist me be able to know if the earnings are continuing to grow and become strong, if the business continue to become stronger and also gaining momentum, and also it will assist me know if the dividends are continuing to grow. And in case I don't own this particular stock, I would watch rather than chase it. I wouldn't just jump on it right now because it has appreciated. I'd rather chill and watch and see how it's performing. And this so because this particular stock has been up 720% in just 1 year. And the yield to date has been almost 280%, right? It basically means the market now has very high expectations on this particular stock. So I would watch and see rather than jump on it. On your end, how would you approach it? Would you buy the stock of Car and General? Would you hold? Or even so, will you just chill and watch before you decide how to go about making an investment decision about this particular stock? Comment down below in the comment section. Let's continue discussing. I hope you've learned a thing or two from this video. Looking forward to share with you other amazing videos next time. Bye bye, and you all stay safe.